Not only is the global bond market larger than the stock market, debt is like the gravity of finance. Once you understand debt and interest rates, it's going to completely change how you see markets and the economy. At a basic level, bond just means borrow money. Let's say we got 5-year-old Bonnie here. She wants to start a lemonade stand in the country club parking lot. Her problem? She has no money to buy supplies. So she goes to her dad and says, "Hey, can I borrow $200? He says, "$200 for a lemonade stand? Are you crazy?" But Bonnie's an enterprising kid. She says, Dad, listen, I've done my homework. The course average is 200 golfers a day. I'll make that money back in a weekend. I'll even give you an extra $20 back for your trouble." That's not too bad of a deal, so he agrees. By the end of the weekend, she's made $1,100, pays her dad back, and buys herself a new $800 kid's Mercedes AMG. Her dad also quits his day job as a bank teller to go work for her. In this little story, Bonnie would be the issuer, Dad would be the investor, the $200 would be the principal, and the $20 as the interest. This is similar to a bond, the main difference being that a bond is packaged up as a security so it can be bought and sold. Unlike Bonnie, we can't always rely on our pappy's bank account for funding. Issuing a bond allows companies or governments to go make purchases that they otherwise couldn't. A town wants to build a new school. They either save up for a decade or they borrow money by issuing a bond today. State wants to build a new bridge. Save up for years or issue a bond. Ford wants to build a new factory to make trucks. Save up or issue a bond. So that's why a company or government would borrow money by issuing a bond. Let's consider this from an investor's perspective. Jim Bob is a school teacher, saved up $1,000 and wants to invest it. He's playing golf with his buddy Frank, who's a financial advisor. Jim Bob tells Frank he wants to buy a bond, but he doesn't know how to pick one out. Frank says, well, there's 3 questions we need to ask. 1, what's the risk I'm not going to be paid back at all? 2, when can I get my money back? And 3, how much am I going to get paid for letting somebody borrow my money? Let's take 3 examples. Bond 1 is from a little biotech company called Get You Right Pharma. Bond 2 is from tech giant Apple. And Bond 3 is from the U.S. government. Frank says, which one of these do you want? Jim Bob says, I don't know, that's why I'm asking you. Frank says, well, I can't tell you unless I know the length and the rate. So let's say that each one of these is for 1 year and it pays 5%. So the when can I get my money is 1 year for each. The how much am I going to get paid is $50 for each, 5% of 1,000. Now what about the risk that the borrower can't pay me back at all? The government bond is backed by the full faith and credit of the government. Apple has hundreds of billions of dollars. They're probably good for 1,000. And then there's Get You Right Pharma. I don't even know what they do. I have no idea if they're going to be able to pay me back. Jim Bob says, well, I like the government best then. Frank says, I'm with you, but problem is everybody else does too. So all the money is going to go into government bonds. Apple says, whoa, wait a minute. Instead of 5% like the U.S. government, we'll pay you 6%. Now that extra 1% of interest is going to entice some investors to start buying the Apple bond. But what about Get You Right Pharma? They say, well, we'll pay 7%. Nobody wants it. Okay, how about 10%? Now they're at double the rate that the U.S. government is paying. They're probably going to get a few investors looking at them. The lesson here is that investors generally demand a higher rate of return based on perceived risk. We always have to remember the term Tonstoffel. There ain't no such thing as a free lunch. So Jim Bob ends up investing in Apple at 6%. Next month, Apple issues new bonds. The new bonds are paying 7%. What happens to Jim Bob's bond interest? Absolutely nothing. It's still paying 6%. That's what he agreed to when he bought it. But Jim Bob doesn't want 6% now. He wants 7%. It's like when I'm paying $100 a month to Comcast for internet, and then they run an ad on TV saying new customers get the internet for $60. So I call Comcast, say, I don't want to pay $100, I want to pay $60. They say, well, that's new customers only. So I threaten to cancel, and they send me to the retention department. Well, Jim Bob can't go to Apple and demand a higher rate. What he can do is he can sell his bond to someone else and buy the new 7%. So Jim Bob puts his bond up for sale for $1,000. Nobody wants it. Why? Well, why would anybody buy Jim Bob's 6% bond when they could just buy the new one at 7%? So Jim Bob then has to sell his 6% bond for less than the $1,000 that he paid. He sells it for $9.90. Then he can go out and buy the 7% bond. And this is where we'll introduce the seesaw graphic for bonds. It shows the changes in price for existing bonds because of what's happening in the interest rate market. Let's say rates went the other way. Jim Bob buys the 7% bond. Then next month, Apple comes out with a bond at 5%. Why would Jim Bob sell a 7% and then buy the new 5%? Of course, he wouldn't unless someone came and offered him more than the $1,000 that he paid. Now, one thing we haven't considered with all this buying and selling is what happens with the interest. Let's say you've got a bond that pays semi-annually like a U.S. bond. You hold it for 5 months and then sell it 1 month before the interest pays. Who gets the interest? What happens is when the buyer buys the bond, they pay you 5 months worth of interest. Then when the interest is paid, it all goes to the buyer. This concept is called accrued interest. Remember, it would be pretty crude for the buyer not to pay the seller when the buyer didn't hold the bond the whole time. How to remember bond terminology. So the first time I had to call into a bond desk was an absolute disaster. The trader might as well have been speaking Spanish. I had to put him on hold, 3 or 4 times and turn around and ask my boss for answers to the questions he was asking me. Eventually, I got so embarrassed, I just started making up answers. Now, I can't save you from every embarrassing conversation, but let's get you up to speed well enough that you can get through the SIE. We're going to use an example here of a golf course green. The first term we're going to learn is par. You might see this as face value or nominal value. On a golf course, par value is the standard for the hole. It's the number that you're measured against. For a bond, par value is what the issuer is agreeing to pay back when the life of the bond is over. It's also the value that's used to calculate interest. So if Apple issues a bond with a par value of $1,000, Apple's borrowing $1,000, they're going to pay back $1,000 whenever the life is over. Next, we see this mature gentleman over here. He's already done with the hole and he's headed back to his cart. That's to help you remember that maturity means the end of the bond. So back to our Apple example, $1,000 par with a 1-year maturity. That means that they're borrowing $1,000, then at the end of 1 year, they have to pay it back. Next, let's look at this irrigation pipe. Think about the water going through the pipe as the money that's going through and paid by the bond. First thing we see is that this pipe is new and it still has the coupon tag attached. Coupon tag says how much water is supposed to be going through the pipe. That's kind of like the coupon with the bond. So there's 2 things to learn here. We've got coupon and coupon rate. Coupon is the dollar amount that the bond pays. It's called coupon because back in the day, they used to give out like paper bonds and they had little coupons you had to clip out of them and take them to the bank to get paid your interest. We also need to know coupon rate. That's the coupon amount divided by the par value of the bond. For example, we have a $1,000 par bond paying 6%. That's going to be $60 per year. $60 is the coupon. 6% is the coupon rate. Now don't let this confuse you, but in practice, a lot of times coupon is used to mean coupon rate. So if you hear somebody say they've got a 6% coupon on a bond, what they really mean is 6% coupon rate. The coupon rate for a bond does not change. A 6% bond pays 6% of par value until maturity. If par value is $1,000, that's going to be $60. If the price of the bond goes down to $900, that's the market value price, the bond doesn't pay 6% of $900. The coupon stays at $60. The coupon rate stays at 6% because it's of the par value, which is still $1,000. Par, coupon, and coupon rate are all the agreed upon terms of the bond. They tell us what the bond does. Price is just a reflection of what someone in the market would be willing to pay for the bond at any given moment. In reality, that bond is really currently paying 6.7% if the price drops to $900. And this is what's known as the current yield. You may have to calculate current yield on the SIE, but it's easy to calculate. It's just how much is the bond currently paying, in our example, $60, divided by the current price, or $900. Our current yield here would be 6.7%. Think about the current yield kind of like a monitor on the pipe showing how much water is actually going through. So the coupon is a piece of paper. It's always going to say 6%, but the monitor is going to tell us that we're getting close to 7% now. Next, we notice how the end of the pipe goes all the way to the mature man. This is to represent yield to maturity. That's the yield you would get if you held the bond all the way to maturity. Now for the SIE, you don't have to know how to calculate yield to maturity. It is important to know that yield to maturity considers not only the interest payments you get over the life of the bond until it matures, but also the difference between what you pay and what the par value is at maturity. So in our example, we paid $900 for the bond, par value is $1,000. That $100 difference is going to be included in the yield to maturity. So current yield means what's the interest doing right now. Yield to maturity, what's the total I get for holding the bond all the way to maturity? What about this pipe here in the middle? You see it goes up and has a phone on the top. If we switch this valve, the water would come up here instead of going all the way to maturity. Some bonds are issued with the stipulation that the issuer can pay them back early. That's called a call feature. Why would they do that? Well, maybe they issued a bond at 10% and then rates dropped. They can now borrow money at 5%. If the bond has a call feature, they're not going to want to keep paying you 10%. They want to call that bond and issue new debt at 5%. So you need to know the terms call and yield to call. Yield to call is just like yield to maturity, but instead of how much would you get holding all the way to maturity, it's how much you would get if the bond was called early. Looking at the bond seesaw, we can start to see the relationship again. It's very testable to know the order of these terms. Now, some students get confused by the concept of prices changing in relationship to interest rates. Keep in mind, this is not for new bonds. This is only bonds that have already been issued. When kids get on the seesaw, they generally do it by setting the seesaw flat and then hopping on at the same time. It's kind of like how bonds are issued and then interest rates can move the price around. Let's talk through an example. Say we're considering a 10-year Amazon bond, par value $1,000 at 6%, callable in 5 years. What's the coupon rate? 6%. What's the coupon? $60 per year. When's the maturity? 10 years. Say we decide not to buy it. Then interest rates go up. Amazon issues a new 10-year bond at 7%, callable at 5 years. Would you rather buy the 6% or the 7%? Both have a par value of $1,000. Personally, if all else equal, I'd rather buy the 7%. Most everybody else would too. So what happens to the price of the 6%? It's going to fall until the decision between the 6% and the 7% is pretty close. So we could either pay $1,000 for 7% or something like $800 for the 6%. What happens to the current yield on the 6%? It goes up, right? Because the coupon of $60 doesn't change. So $60 off of $800, which is the price, is about 7.5%. What happens to yield to maturity? It goes up even more. Remember, yield to maturity is what happens if you hold the bond all the way to maturity. So we would pay $800 for the 6% bond. It's still going to pay us $60 per year. Then at maturity, we would get back $1,000. Remember, par doesn't change. Okay, what about yield to call? Now this trips up a lot of students because it seems like maturity should be at the end. But think about what happens if the bond is called early. I pay $800 to buy the bond. I then get $60 per year, but then I get $1,000 back early. You take this to the extreme and it makes sense. What if I bought the bond for $800 today and then it gets called tomorrow? That's going to be $200 for holding the bond just one day. That's a 25% return for one day. If you can make 25% per day, you're going to be the richest person in the world in a few months. So instead of getting a below market coupon for the full time, I get the full par value early and I can go buy a new bond at full market. Obviously, it's not very likely that you're going to get called on a bond when interest rates have gone up. Now to hammer this home, let's take the flip side. There's a bond paying 6%, then rates drop down to 5%. Now everyone wants the old 6%, not the new 5%, so the price goes up to say $1,200. What's the coupon? 6% is still $60 per year. What's the current yield? 60 divided by 1,200 is still 5. Would the yield to maturity be higher or lower than the current yield? Well, I have to pay $1,200, but I only get back $1,000 at maturity. So yield to maturity is going to be lower. What about yield to call? If I pay $1,200 today, which is above par, I'm going to want to keep getting that $60 coupon as long as possible. So if they call it, that means I get less than I paid for par and I get it back sooner. Yield to call is going to be lower than yield to maturity. Now lastly, we see this convertible parked over here. That represents convertible bonds. If you hop in the convertible, you're no longer a golfer, you're now a driver. That's similar to how bonds work with a convertible feature. That means you can trade in your bonds to get stock. That changes you, the investor, from a creditor to an owner in the business. The way a convertible feature typically works is the bond has a conversion price. Let's say we have a Nike 5-year convertible bond, par value of $1,000, conversion price of $100. The conversion price is the price of the stock that we can convert at. A few years later, Nike stock has gone up to $110. If you, as the bondholder, have discretion, you can tell Nike, convert my bond to shares of common stock. We take the par value of 1,000, we divide it by the conversion price of 100, and you can see that you get 10 shares of Nike stock. This is good for you because Nike's trading at 110. It's also good for Nike because they don't have to pay the bond back. It does dilute existing shareholders. Also note that convertibles usually pay a lower interest rate than non-convertibles because of the equity upside. Now, what if Nike stock was at $80? Would we want to convert? No. We would still divide our $1,000 by the conversion price of 100. That's still 10 shares of Nike, but it's priced at $80 or $800 in total. I would much rather have $1,000 in cash returned to me than $800 of Nike stock. Let's talk types of bonds. For this, we're going to consider different types of water pipes that we could use. Think about the water flowing through as interest you get from the bond. Remember, we always assume an inverse relationship between risk and reward. First, we have corporate bonds. These are like plastic PVC pipes. They're generally strong enough for most applications, but they will fail occasionally. You can increase the thickness of the wall to make the pipe stronger, but at the expense of how much water can get through the pipe. That's similar to the way that you can buy a bond from a company in a stronger financial position, but they're probably going to pay you less interest than a company with fewer resources. Would you rather lend money to a $1 trillion company or Get You Right Pharma? Get You Right is going to have to pay me a lot more for me to buy their bond. They've got thin walls and they might collapse. Now, corporate bonds, they can be secured or unsecured. If they are secured, that means if the company fails, you have the right to sell some company assets to recoup your money. It could be real estate, equipment, or other securities. Unsecured means there's nothing specifically tied to the bond other than a company's promise to pay. Next, we have government bonds. These are like thick stainless steel pipes that are almost certain not to break down. You do have to give up some water flow for the safety though. They have names based on length. The shortest are bills, 1 year or less. Think about your water bill. They're not going to give you over a year to pay your water bill before they shut your water off. Bills are a little unique in that they don't pay interest. Instead, they're sold at a discount. Your interest is the difference between the discounted amount that you pay and the par value that you get at maturity. So you may pay $950 for a T-bill and then get $1,000 back at maturity. Then we have notes. They're 2 to 10 years. Remember, kids pass notes in class. Next is bonds, which are 20 to 30 years. These are around for decades, kind of like how 007 James Bond has been around for decades. Beyond those, we have additional securities called TIPS and strips. TIPS are Treasury inflation protected securities. It's highly likely you will see a question about TIPS on the SIE. The IP, remember the IP stands for inflation protection. As the name implies, these securities are adjusted for inflation using the Consumer Price Index, or CPI. TIPS are different from most other fixed income type investments because the principal and interest fluctuate over time. They mature in 5, 10, or 30 years. Say you buy a $1,000 tip paying 5% or $50. CPI then goes up by 10%. The par value on your tip is going to increase to $1,100. Interest gets adjusted as well, so you would start getting $55. Now, during times of deflation, the principal amount can go lower. So again, say we bought a tip, $1,000, paying 5%, $50 a year. Then we have deflation, which is the opposite of inflation. And principal goes to $900. The interest would then drop to $45, which is 5% of $900. Now, if a tip matures, you don't get less than what you paid. Now, in our first example, you would get $1,100 because inflation had gone up. In the second example, you would still get $1,000 even though the principal had dropped to $900 because you can't get less than what you paid. Next, we have strips. A strip is like a treasury bond where they strip away all the interest payments. They then make those interest payments and the return of principal new separate securities. For example, we have a bond with 10 years remaining. That means there's 20 interest payments and 1 principal payment. Instead of a customer having the option to buy one bond and get all 21 payments, they would be split up into 21 different securities. Let's say a bond has a $40,000 value and it's paying 5%. Each interest payment would be for $1,000. So maybe you could buy this one for $950 and get $1,000 a year from now. Or you could buy this one for $900 and get $1,000 in 2 years. You could even buy the principal payment, say for like $25,000, and get $40,000 back in 10 years. With strips, you may see the terms 0 or 0 coupon bonds. That's because there's no interest payment on the way to maturity like normal bonds. You just buy those at a discount, and the price increase at maturity is considered the interest. Now, similar to strips, you might see treasury receipts, which are basically strips, but they're created by broker-dealers. Don't be confused by the name. Strips are securities backed by the U.S. government. Treasury receipts are securities created by broker-dealers. I'm not actually sure if anyone still issues treasury receipts at this point. I only mention that just in case you see it on the test, at least you've heard about it. Now, treasuries are generally taxable at the federal level, but exempt from state and local taxes. Treasuries are often quoted in 30 seconds. So if you see something like 101.16 with a par value of 1,000, that means the price would be 101 and 16 30-seconds of par, or 101.5% of par, which would be $1,015. Other bonds are typically quoted by price and yield. Next, we have galvanized steel pipes, which represent government agency securities. Agencies meaning they're separate entities from the U.S. government, but still have close ties to the government. For example, Fannie Mae, Freddie Mac, and Ginnie Mae all are supposed to help reduce home buying costs. Fannie and Freddie were created by Congress but are not part of the government. Ginnie Mae is owned by the U.S. government. Most agencies are taxable at both the federal and state level, with a few exceptions. Next, we have insulated copper pipes to represent municipal bonds. Think like state and local governments here. We often call these munis. Copper is usually more durable than PVC, remember like corporates, but they're not as strong as the thick stainless steel of governments. It has an insulation layer to represent the tax benefit, which usually is the main reason for buying munis. So there's two important things to know about munis. First, you usually buy them on a tax equivalent yield. So buying a muni paying 5% might look as good as a corporate paying 6% because you have to pay taxes on the 6% bond, but no taxes on the muni paying 5%. The second common testable idea is revenue versus general obligation bonds. If you have a revenue bond, it's tied to a specific project. So maybe it's a toll road for a state. The state issues bonds to borrow money to build the toll road. Then proceeds from the tolls collected are used to pay the interest and pay back the bondholders. Could be a city building a golf course. On the other hand, general obligations are not tied to a specific project. The municipality can use any revenue source to pay back the bond. Could be taxes, fees, tolls. General obligations are usually seen as less risky than revenue bonds. For a revenue bond, let's say they built the toll road and the state expects 50,000 cars per day on the road. The road opens and they only average 20,000 cars. The toll road might not have the revenue to cover the interest and pay back the bonds. The state could say they don't have the money to pay you back, and they have no obligation to take other monies from different revenue sources to make you whole. How to remember bond ratings. There are 3 rating agencies for bonds: Moody's, S&P, and Fitch. Think of it like a credit score for companies and governments. Each of the rating agencies have a proprietary system to assess and rate how risky a debt issuer is. To help remember, we have all these golfers here ready for the club championship. The top 4 golfers are pro golfers. The rest are amateurs. This is similar to the distinction of investment grade versus speculative. For speculative, you could also see it called high yield or junk. The distinction is important because some money managers can only invest in investment grade bonds. Now, this cutoff between investment grade and speculative is highly testable in the SIE. Now there's a chance you could be asked to put the ratings in order. The key to remember is that the more letters is better, and that's why we've grouped the golfers like this. AAA is better than AA. If you get numbers, it's the opposite. A1 is better than A2. Bonds are generally seen as safer investments than things like stocks, but bonds are not without risk. The hazards of this hole are going to help you remember those risks. First thing we notice is the wind is blowing really hard. That's going to influence where our ball lands. That's like interest rate risk for bonds. Interest rates in the market influence the price of existing bonds. If rates go up, then prices go down. And if rates go down, then prices go up. To mitigate the wind, we can hit our ball shorter because the longer the ball is in the air, the more influence the wind is going to have. With bonds, the longer the maturity, the more influence changes in interest rates will have. But there's a trade-off because buying shorter-term bonds generally comes with lower interest. Next, we see the course marshal. He's on his phone to represent call risk. The marshal can kick us off the course if we're not making them any money. Maybe we smuggled in our own snacks instead of buying theirs. Or we're playing too slow and backing up everybody else. That's similar to how a company might call your bond if you bought it and then interest rates go down. Say you bought and you're holding on to an 8% bond, but interest rates go down and now the company can borrow at 5%. They're not going to want to keep paying you 8% when they can pay somebody else 5%. Now there can be call protection. For example, maybe the bond isn't callable for the first 3 years. So even if you buy the bond and interest rates go down tomorrow, there's nothing the company can do until the call protection period is up. The other protection could be price. The par value on the bond is $1,000. If the bond is held to maturity, you would get $1,000. But there's a provision on the bond that says if the company calls it, they have to pay you a premium of $50. So when the company calls the bond, you get $1,050 instead of just $1,000. Next, we have a water hazard. If you hit the ball into the water hazard, you're going to have trouble getting it back. The liquid water represents liquidity risk. That's the risk that you buy a bond and then later can't sell it quickly at a fair price. To avoid the water, we can just stick to hitting it in the fairway. Let's play it down the middle. With bonds, we can stick with larger, well-known issues that have active markets. Another option is just to hold the bond to maturity. Next, we see this kid hiding in the bushes. There's a risk he's going to run out and steal your ball and you won't get to finish the hole. This little menace is named credit risk. Like with the bond, credit risk is the risk that the issuer can't meet the obligation. In that instance, you may receive payments of interest and principal either late, partial payments, or no payments at all. To mitigate credit risk, we can buy higher rated bonds and diversify our holdings. Lastly, we have a sand trap with an inflatable flamingo. That represents inflation risk. Bonds normally pay a fixed amount of interest. That fixed amount becomes worth less and less over time. Let's say you bought a 100-year bond in 1926 that paid $25. You could buy a whole cow with that $25 back then. In 2026, you could barely get a hamburger. The higher inflation runs, the more it impacts your bond. TIPS are one option to mitigate inflation risk. Remember, TIPS are Treasury inflation-protected securities. The other option is to buy stocks, which generally increase with inflation. Now to recap, the wind is like interest rates, which pushes your bond price around. The marshal calling is like call risk, where the issuer calls in your bond. Now the liquid water should remind you of liquidity risk, or the risk that you can't sell your bond quickly at a fair price. The credit risk kid can take your ball and not let you finish the hole, like an issuer defaulting on your bond. And then the inflatable flamingo represents inflation risk, where fixed payments become worth less and less over time.